Margaret is 68, a retired teacher. Last year she sold a few boxes of old books and some handmade greetings cards on eBay. Nothing unusual, just clearing space and covering a bit of pocket money. Her total sales came to £1,200. Then a letter arrived from HMRC. No accusation in it, just a reminder that they had data showing income from an online platform, and they wanted her to check whether she needed to report it. Here is the problem with that letter. The number HMRC had was £1,200, the gross sales figure. But Margaret's actual profit after materials, postage, and eBay fees was closer to £200, and under a rule many retirees have never heard of, that £200 profit sits well below the threshold at which any tax becomes due. She didn't owe anything, but she nearly paid anyway, because the letter looked official, the number looked large, and she just wanted it to go away. That's the trap, not the tax itself, the fear around it. In this video, I'm going to show you exactly how HMRC's 2026 crackdown works, why most retirees selling on eBay or at car boot sales are not the real target, and the two simple rules that keep your money safe. Because if you know where you stand, a letter like this stops being frightening and starts being manageable. Let me explain what is actually happening with HMRC's push in 2026, because the headlines make it sound more alarming than it needs to be. HMRC has two tools working in the background. The first is Connect, their AI system that pulls data from banks, online platforms, and even social media to cross-check what people declare. The second is a change called Making Tax Digital for income tax, which from April 2026 requires certain people to submit quarterly digital updates to HMRC rather than one annual tax return. That second one, the digital reporting, is where a lot of the worry is coming from. But here is the key number. Making tax digital applies to self-employment or rental income above £50,000 per year. If you are retired, drawing a state pension and maybe selling a few things on the side, you are almost certainly nowhere near that threshold. The rule was designed for self-employed tradespeople and landlords with significant rental portfolios, not for someone clearing out the spare room. If you are a retiree with a state pension and a few small sales, you are not the primary target of these new rules. But you can still get caught in the net if you do not know where you stand. That is the distinction worth holding on to. Here is what the evidence shows. Each year HMRC sends out large volumes of nudge letters, what they call one-to-many correspondence, to people they believe may have undeclared income. Many of those letters go to people who owe nothing at all. People whose selling activity is either below the threshold or qualifies for an allowance they did not know existed. The letter itself is not an accusation. It is a prompt. HMRC's systems flagged a number. Your job is to check whether that number means anything. Now, what happens to people who do not check? The fragility path looks like this. Receive a letter. Feel anxious. Assume the worst. Pay the amount to make it stop. That is money lost that was never owed. And because paying without disputing tells HMRC nothing is wrong, the data sits uncorrected, meaning it can happen again. The resilience path looks different. Understand the thresholds. Know your allowances. Respond factually if asked. Keep your money. Close the case. Most people end up on the fragility path not because they are uninformed, but because they do not know which rule applies to them. That is what the next section covers. There are two things you need to understand to protect yourself. The first is the trading allowance. The second is something called the badges of trade. Together they form the framework that tells you whether you owe anything, and if HMRC asks questions, how to answer them. Start with the trading allowance. This is a rule that says if your gross income from self-employment or casual selling is £1,000 or less in a tax year, you do not need to report it to HMRC and no tax is due. Not on the profit, on the gross total. Under £1,000 coming in, the whole thing sits outside the reporting requirement. If your gross sales are over £1,000, the allowance still helps. You can choose to use it as a deduction, taking £1,000 off your gross income, instead of calculating and claiming your actual expenses. In many cases that produces the same or a better result than going through every receipt. Let me walk through Margaret's numbers so this is concrete. Her gross sales were £1,200. Her actual costs, materials for the cards, postage, eBay fees, and the original price she paid for the books, came to around £1,000, so her profit was roughly £200. Two options here. She could use the trading allowance, which leaves £200 of gross income above the allowance threshold, but with no profit to speak of, or she could claim actual expenses, which also leaves £200 of profit. Either way, nothing to pay. The £1,200 that looked alarming becomes a non-event once you run the numbers. The trading allowance is per person per tax year. It does not carry over, and it does not stack with a partner's allowance. But for most retirees doing occasional selling, it is the first and most important number to check. Now, I used to think that any sale over £1,000 automatically meant a tax bill. I remember sitting at my kitchen table with a bank statement, adding up figures, thinking this cannot be right. Then I found out about the trading allowance, and the whole picture changed. The number that looked like a problem was actually fine once the rule was applied. That brings me to the second part of the framework. The badges of trade. This is how HMRC decides whether your activity is a business or simply the disposal of personal possessions. HMRC has 9 criteria, but a handful matter most in practice: whether you had a profit motive when you acquired the items, how frequently you sell, whether you organize the activity like a business, how long you owned the items before selling, and whether you modified items to make them more saleable, selling your own things that you no longer want. Furniture, books, clothes, items from the attic does not look like a business under those tests. You bought them to use. You are selling because they have served their purpose. There is no stock, no buying cycle, no margin calculation. Contrast that with John, 72, who goes to car boot sales every Saturday, picks up vintage tools he knows he can flip on eBay, stores them in the garage, and turns a consistent profit. He is running a business. He needs to register with HMRC and pay tax on his profits. The badges of trade point clearly in that direction. The distinction is not about the platform you use. It is about the nature of what you are doing. The same eBay account can be personal selling in one case and a business in another, and the difference comes down to intent and pattern. Knowing where you sit in that framework is what determines your response to any HMRC inquiry. And for most retirees doing occasional selling, the answer is clear. It is worth understanding why HMRC is paying attention to this area at all, because it feels disproportionate. Someone selling old books on eBay, why would a government agency be monitoring that? The answer goes back to a problem called the tax gap. That is the official term for the difference between the tax HMRC believes should be paid and what is actually collected. According to HMRC's own published statistics, the tax gap for 2023 to 2024 was estimated at £46.8 billion. Most of that comes from large-scale evasion and error, businesses misreporting income, landlords not declaring rent, complex offshore structures. But closing even a small portion of it is now economically viable in a way it was not 20 years ago. The reason is technology. HMRC's Connect system can cross-reference data from banks, digital platforms, and companies' house in seconds. The same analysis that used to require several analysts working for several days now happens automatically. That changes the cost calculation for HMRC. It is no longer expensive to send a letter to someone with £1,200 of eBay sales because the system identifies them without human effort. That is the structural shift. HMRC did not suddenly decide that pensioners selling handmade cards were a priority. They built a system that catches everything in the net, including things that should not be there. The nudge letters that arrive on people's doormats are a direct result of that. Volume correspondence generated by an automated process, not targeted enforcement. Most people who receive those letters owe nothing. They simply did not know where they stood. What you need is not luck. It is the right information to respond confidently. When a letter arrives from HMRC, there are 2 ways this goes. The difference between them is not about being clever with money. It is about knowing enough to pause before you react. The fragility path starts with the letter. You open it, see the official letterhead, notice a number, and feel the pull to just deal with it. Pay the amount, move on. That emotional response is completely understandable, but it is also exactly what leads to paying money you never owed. And the cost does not stop at that first payment. If you pay without checking, the underlying data stays uncorrected in HMRC's system. Future letters become more likely, not less. Think about what that adds up to over 5 years. If a retiree pays 1 or 2 nudge letter demands without checking, say an average of £300 per letter, that is potentially £600 to £1,500 in overpaid tax. Money that was earned, kept, and then handed back unnecessarily. The resilience path looks different, and it is not complicated. You receive the letter. You do not pay immediately. You check your records against the 2 rules, the trading allowance and the badges of trade. If your activity is genuinely personal selling and your gross income is under £1,000, you have nothing to report and nothing to pay. If it is over £1,000, you run the numbers with the allowance applied. If you have a profit figure, you check it against your personal allowance for the year. Then, if HMRC has asked a specific question, you respond to that question directly and factually. No more than they asked for. That second path costs nothing except a bit of time, but it requires knowing the rules exist in the first place. Which is exactly why most people default to the first path. Not because they are careless, because no one told them. The gap between those 2 paths is not intelligence or financial sophistication. It is information, and once you have it, the choice becomes straightforward. There is one more scenario worth preparing for, because it catches people who already know the rules, and that is when HMRC's data is simply incorrect. Back to Margaret. A year after her eBay sales, she receives another letter. This time the figure HMRC has for her platform income is significantly higher, close to £800 above what she actually received. She checks her eBay records. The discrepancy is real. What has happened here is not unusual. HMRC's data comes from third-party sources, the platforms themselves, bank feeds, data matching systems. That data can contain errors, a closed account that was not properly deregistered from a platform, a refund that was not netted off, sales from a shared account where only part of the income belongs to one person. HMRC's own annual report and accounts acknowledge that complaints frequently relate to inaccuracies in tax codes and assessments, with third-party data being a recurring source of the problem. If HMRC has the wrong number, you have the right to correct it, and you have the tools to do so. The unprepared response is to pay the demand anyway. It feels easier, the figure is not enormous, and the paperwork feels daunting. But that payment does not correct the record. HMRC simply closes the compliance case while the wrong data remains in their system. The prepared response starts with a data subject access request, a formal request for HMRC to share the data they hold about you. HMRC is required to respond within 30 days. Once you have the data, you can identify precisely where the error is, then write a straightforward factual response. Here is what I received, here is the evidence, here is the discrepancy. Bank statements, platform transaction records, screenshots, whatever matches the period in question. This is not a confrontation, it is a correction. HMRC's own processes are set up for this. When you provide clear evidence that their figure is wrong, they adjust it. The key is not to panic and not to pay before you've checked. Those 2 things, stay calm, check first, are the whole strategy. If you sell anything, on eBay, at a car boot sale, through Facebook Marketplace, or anywhere else, there are 4 straightforward things that keep you safe. The first is to know your trading allowance number. Sit down at the end of each tax year and add up your gross sales from all your activities. If the total is under £1,000, you have nothing to declare and nothing to pay. Write that number down and keep it with your records. That is your first line of defense. If your gross sales are over £1,000, move to the second step. Calculate your actual profit. List your costs, materials, postage, platform fees, and what you originally paid for the items. Subtract them from your sales. Then decide whether to claim actual expenses or apply the £1,000 trading allowance as a flat deduction. Use whichever gives you the lower taxable figure. The third step is the badges of trade test. Ask yourself a few honest questions. Did you buy these items specifically to sell them for a profit? Do you do this on a regular, organized basis? Do you hold stock and manage the activity like a business? If the honest answer to most of those is no, because you are selling things you owned and used, occasionally, with no profit motive when you bought them, then you are in personal selling territory, not business territory. That distinction is what protects you if HMRC asks. Now, it is worth being clear about the boundary. John, 72, who goes to car boot sales weekly, buys vintage tools specifically to resell on eBay, keeps a garage full of stock, and tracks his margins. That is a business. HMRC's badges of trade point that way clearly. He should be registered and paying tax on his profit. Margaret, selling handmade cards and clearing old books, is in a completely different situation. Same platform, different story. The fourth step is about letters. If you receive a nudge letter from HMRC, do not pay immediately. Do not ignore it either. Read it carefully to understand exactly what they are asking. Most nudge letters ask only whether you have considered your tax position, not that you definitely owe money. Check your records against steps 1 and 2. If everything is in order, write a brief factual response. What you sold, what your gross income was, how the trading allowance applies, and what your final tax position is. If the figure HMRC quotes does not match your records, submit a data subject access request. Ask them to share the data behind the letter. Once you have it, compare it to your own records and identify the discrepancy. I've been there myself. I once got a letter about a small amount and almost paid it before stopping to check. I'm glad I stopped. The check took 20 minutes and saved me money I did not owe. Keep simple records. A notebook or a spreadsheet with date, item sold, sale price, what you paid for it, and any additional costs. That is all you need. You do not need an accountant for this level of activity. What you need is a clear record that lets you answer any question factually and quickly. If this is helping, please do subscribe. I cover more topics like this each week, aimed at keeping your retirement finances as simple and secure as possible. There is a reason people pay tax demands they do not owe, and it is not because they are careless or naive. It is because of the way our brains handle perceived threats. Loss aversion is the psychological principle at work here. Research consistently shows that the fear of losing something feels roughly twice as powerful as the satisfaction of gaining the same amount. A letter from HMRC does not arrive framed as an opportunity. It arrives framed as a risk, and your instinct is to neutralize the risk quickly by paying. Add to that the authority effect. HMRC carries the weight of official government correspondence. The letterhead, the formal language, the reference numbers, all of it signals that this is serious and that you should comply. For people who've spent their working lives paying taxes correctly, that instinct to comply is deeply ingrained. That combination, loss aversion and deference to authority, is what makes nudge letters effective even when the recipient owes nothing. It is not a deliberate manipulation. It is simply how official correspondence interacts with ordinary human psychology. I've felt it too. That moment when you open a brown envelope and your stomach drops. Your brain immediately starts calculating risk, not rights. The shift that helps is a small one. Instead of reading the letter as I am in trouble, read it as I have a right to check if they are correct. HMRC's own guidance acknowledges that their data can contain errors, and their complaints process exists specifically for situations where demands are wrong. Once you make that shift, from assumption of guilt to assumption of the right to verify, the fear loses most of its power. And from that position, you can take the practical steps we covered, rather than simply paying to make the discomfort stop. Let me bring this back to the two things that actually matter. The trading allowance gives you a £1,000 buffer. If your gross sales are under that figure, you have nothing to declare. If they are over it, you can use the allowance as a deduction or offset your actual costs, whichever leaves you with the lower taxable amount. In most cases involving occasional selling of personal possessions, the final taxable figure is small or zero. The badges of trade give you a clear test. Are you selling things you owned and used, occasionally without a profit motive when you acquired them? Then you are not running a business. You are a private individual selling personal property, and HMRC's 2026 enforcement push was not designed for you. That does not mean ignoring letters. It means reading them calmly, checking your position against these two rules, and responding factually if required. Most of the time, that is all it takes. You have worked hard for this retirement. The money in your account, the modest income from occasional sales, the hobbies that have become a small source of extra funds. None of that should be handed over to HMRC out of fear, especially when the rules say it is yours to keep. Most retirees in this situation owe nothing. They just did not know it. Now you do. If you found this useful, please subscribe. It genuinely helps me make more videos like this. And if you have a specific question about your own situation, drop it in the comments. I read them all, and I will do my best to point you in the right direction. Remember, HMRC's data shows the number. You know the story. Make sure you tell it.